Hey folks, Dan Frio here, the rate update. Today is January 11th, 2021. What happened to rates today? Well, since the Georgia election, you won't like what's going on with rates. We'll be right back. So the question is, have we seen the end of low rates? And the election from last week, I'm not getting into politics, but the election of last week kind of threw a curveball to the markets because the markets anticipated the Republicans winning at least one seat and keeping control of the Senate. That didn't happen. So now we have a Democratic president, Democratic House, Democratic Senate, thus eliminating any gridlock. So whatever they want to go to pass is going to pass. One big thing of that is the stimulus package. Plus, in the Democratic controlled piece of all this, there are probably going to be more and more and more perks out there, or more stimulus. Okay. Great for the economy short term. You guys know how I feel on that. No political pieces on here. I'm just saying financially, it's a great thing short term. Long term, how's this all getting paid for? Well, the government has to issue more and more debt. Okay? So when they issue debt, now there's more and more debt out there in regards, and that debt is represented in the market as treasuries. Okay? So they issue more treasuries to pull in extra money to lend out or give out. But you're not going to have that much of an increase in demand. So when you have something in excess supply, that is going to push down the prices. You have too much of something with a finite demand. That's going to push down prices to find an equilibrium. And in turn, when we know in bonds, all bonds, the lower you pay for something or the lower the price, the higher the yield. Okay, so what's happening right now is exactly that. And it's pushing up yields in the Treasury market. Well, normally, in most cases, the MBS market, which we follow here, correlates somewhat with the 10-year Treasury. Not always does it actually correlate. But in this time frame, unfortunately, it is coordinating those numbers. So let me show you via the charts kind of what I mean by a lot of this. Here's the 10-year Treasury yield. Okay, this is back when they brought up the stimulus in March of 2020. You can see when the stimulus package was approved, we had a huge spike in the Treasury yield. Okay, and again, I explained why. You go down through here, and here's what happened with the Georgia election. We were kind of in a stagnant environment right here, and we were trading in a tighter and tighter range. But then as soon as the election completed, you saw treasuries spike again, okay, like we did in March with the Corona stimulus package. Now they're saying, or the assumption is, they're going to be pumping out more and more and more stimulus, thus having to issue more government debt, thus pushing down the prices and increasing the yields. Okay, I hope you follow all that. Here's what has happened to mortgage rates. So we saw them, they dramatically dropped and dropped and dropped and dropped. And then all of a sudden, we see a big spike this week, or it was basically last week. And the reason being is the MBS market is starting to kind of trade in the same realm as the 10-year treasuries. And again, here's another 10-year treasury yield. The election, and we had a huge spike. Okay, now here's the correlation between 10-year treasuries and mortgage-backed securities. So you see them moving. This is the mortgage rates. So we see that moving. But then in October, we had a kind of a disconnect. And that was during the election was right around the corner, and all kind of other things were taking place. But you can see the correlation is as rates or 10-year Treasury yields would go up, mortgage rates would go up. They come down, they'd come down. But then we split the correlation here. But then all of a sudden it started picking up again. So you can see there's a little move up there, move up there, move up there, move not really there. But now it's starting to correlate again even more. So you're having mortgage rates jump or spike just like the 10-year Treasury is going to do. All right, breaking news right now is all the turmoil that's out there, between impeachments and everything else. That's throwing a curveball to everything. And then we have the 10-year Treasury yields rising following the biggest week since last June. So that's what's going on with Treasuries or bonds in general. So now let's get to the mortgage-backed securities market that you follow me for. We are getting hammered, just hammered. And I've been locking people basically once we came or hit this trigger level here, and I'll go over these lines with you here, basically since last week. If you go back to my last week's videos, I had concerns right here. And I said, you know what, we keep hitting this Fibonacci level right here, but we're not going over it. So that's telling me we're kind of at a top. So we hit it here, and it's been a really resilient line. Hit it here, hit it here, hit it here, hit it here. Okay. So if you go back to my videos, I said, if we don't exceed this and move up, we should probably see a correction. And my assumption at that time was a correction to about this level right here. Okay, the reason being is that's where if you cut a line in between this, that's basically where we've been trading, and that's where the Fed has kind of pegged some of the numbers to be. Then there's other lines in here. You have a purple, a black, and a brown. The purple is a 100-day moving average, black is a 50-day moving average, and the brown is a 25-day moving average. It gives us a little more micro snapshot of these charts. So the assumption was we weren't peaking past this line here. We would move down into equilibrium, about the 25-day moving average, which again, if you cut this in half, that's about where we would be. So that's where I thought we would hit a big resistance. Well, we kind of did right here. And this was last, I forget what it was, Tuesday, I want to say. And then the next day we broke it. And we basically went down and blew through the 50-day moving average on our way to the 100-day moving average. And then last week we blew through the 100-day moving average, but we still had this line right here. This is the Fibonacci bottom. Okay, what Fibonacci levels are when you're charting, it basically gives you a region that you're going to trade between. It gives you a ceiling and a floor. Well, normally you hit that floor and you just basically stop to a point. We blew through that today with no problem, and that is concerning. So I'm going to say this bluntly. I'm monitoring this on a tick by tick by tick basis. There is way overreaction in the markets. It is well due because of everything going on. So we should start hitting an equilibrium here. We should be capping out on the 10-year Treasury because a lot of this stuff is baked in. But until the stimulus package is passed and to what extent the benefits are going to be, we still have uncertainty. And we still have an uncertainty in regards to impeachment, the swearing in of the new president on the 20th, people going to jail. Guys, it's terrible out there, and I'm not going to sugarcoat it. The government or the Fed's not going to let this continue to have a bloodbath and mortgage rates spike high, because there's a lot of people in forbearance. There's a lot of people that owe a bunch of money on their mortgages. And the government, the Fed, everybody learned their lessons back in 2008 on how you can't let the housing market just completely crash because you're going to crash the whole world. So the Fed will probably step in and start increasing their purchasing of mortgage-backed securities and other bonds to bring an equilibrium. That equilibrium could be, where I predicted it here. It could be down here. If you go longer term out, it could be, if you look at this chart, an equilibrium should be about in this range here. And that's basically where we kind of are. We're a little bit below that, but we should be ticking up into this range right in here. And that's what I'm predicting over the next couple days until all of this settles. So that's where we are there. The economic calendar this week, Federal Chairman Powell, he's in charge of the Federal Reserve. He's going to speak on Thursday. That will move the markets. We could see a reversal of this back into this range. That's what I'm predicting. I don't think he's going to say anything to spook the markets even more, to crash it even more. So Thursday is going to be a huge day, but until that point, I'm going to be monitoring, the news out and what's going on with the stimulus package and everything else. My chart for today with mortgage rates, we're still way down. So this isn't to spook anybody. We're still about 1 full percent below where we were last year at this time. So the 30-year conforming jumbo FHA and VA, right now those numbers are nationally on average 2.83 for a 30-year conventional loan, 2.89 for jumbos, 2.82 for FHA, and 2.42 for VA loans. And they're basically right in line. They haven't moved too much. Today they will be, because we had this. Let's look at the daily chart. What happened intraday, and I'll get you the whole picture there so we can see that the whole day. It's just been one big. By the time this was posted, we were only right in this range here. So we've had continued deterioration in the markets from there. So this number is going to even be worse tomorrow. But again, in the long term, we're still 1% lower than where we were. Federal Chairman Powell should be coming in. My assumption would be he's going to say some things to ease the market, to kind of bring us back into equilibrium and to be trading where we are. I think the markets have overreacted, and we should be trading in this range here. So I'm not looking to lock anybody additionally. We locked right in this range here last week. A lot of people right in here. And we honored, if we told you we were getting you a specific rate, you applied and you had your application in, we will honor those rates. But get your applications in. It's the only way we can follow this. Other than that, I'm sorry this was kind of a lengthy video. What I ask people on a daily basis is, if you're in the process of a mortgage right now, you're building a house, buying a house, refinancing, you're not locked in, get another opinion from, or get another quote from your lender. Send that quote to me. I'm going to show you my email address here in a second. Give me your quote. If your rate is over 4 and you have a mortgage, do something now. Don't put your head in the sand any longer. Jump now. We probably saw a bottom of rates unless we go into another huge recession, depression. I don't think the Fed and the government's going to allow us to do that. They're going to pump in just gobs of stimulus to balance out the markets. So let me show you how you get your information to us, or you reach out to us for some assistance. The best way is to go to my website. It's therateupdate.com. You're going to scroll down to the bottom. This is our 800 number. Call it anytime. If it's during office hours, somebody should pick up. If they don't, leave a message. We'll get back with you as quick as we can. If you find for some reason you can't get through to this number, feel free to email me. My name is Dan Frio. My email address is dfrio, which is Frio, at preferredrate.com. If you want to get an application started, this is the best way to do that. Even if we don't do your loan, you just have your application in and we can monitor rates for you. I can't monitor rates if I don't have any of your information. So to get your information in, hit the Apply Now button and start the mortgage application. We won't lock you in. We won't pull your credit. We'll at least reach out to you saying, what are you looking to do? What do you have? Are we a second opinion for you? Are we your first opinion? What's going on? How can we help you? We have your application in process. I would suggest we not lock unless we have further deterioration in the market, because I think we're going to have a little bit of a comeback in rates to the good. So just hit the Apply Now button. You'll get a notification instantly when you're done, and then somebody will be reaching out to you probably within 15-20 minutes of you finalizing your application. The only last thing I want to ask of you is, please help me boost up my algorithms on YouTube by giving me a thumbs up, hitting the subscribe button down below, clicking the bell So every time I do post a video, you get an alert. Other than that, God bless. Sorry for the bad news today, guys, but it's the facts. There's no fake news here. I'll give you nothing but the facts. So have a great day. I'll see you tomorrow. Bye-bye.